We'll start with financial instruments. Sir, financial instruments actually is a standard, is a mixture of three standards. One is Ind AS 32, Ind AS 109 and Ind AS 107. Ind AS 107 is a purely disclosure standard, sir. It has got nothing much to do from an examination perspective. Of course, I can't say like that because whenever I say that this is not very important from an exam, usually a question pops out in the exam. So, there's something called as commentator curse in the cricket matches, something like that. So, anyway, generally, it's more practical oriented rather than exam oriented, but nevertheless, that's part of syllabus. The main standards, what we have to put focus is the first and the second standard, that is 32 and 109. In Ind AS 32, it deals with presentation of financial statements. So forget about the title of Ind AS 32, but what is there inside Ind AS 32 is, it tells you the definition of financial asset, financial liability, equity instrument, derivative, and then it gives you some basic concepts of how to classify between an equity and a financial liability, and some very limited accounting treatment is given under Ind AS 32. Ind AS 32, if I say, there is 95% theory, or 5% accounting discussion is there, only 5%. Rest all is core dry theory. It will be definitely dry, there is no option. But the more clearly you understand Ind AS 32, your life will become more simple in Ind AS 109. Ind AS 32, whatever theory bases are taught, for that accounting applications will be there in Ind AS 109. So 109 is proper accounting standards, and means where recognition and measurement principles are there. Whenever recognition and measurement principles are there, we just have to understand a concept and do questions on that. It will be like that. It will be definitely heavy, sir. First mentally get prepared, but at the same time it will be very interesting once you start Ind AS 109. But Ind AS 32 is little theoretical, slightly dry, but it is something which we cannot postpone it to later stage, because without understanding the basic definitions and the basic concepts, there is no point of how you can learn accounting in this. So first 32 and thereafter 109. 107, last subject to time availability I will discuss. That is only 1.5 page of disclosure. There is nothing much in that. Okay. Now, the first part, as usual, since the standards we are talking now deals with financial instrument, they define what is a financial instrument. Now, how financial instrument is defined is, first he says financial instrument is a contract. Sir, if there has to be a contract, at least how many parties are required? 2 parties are required. So there is a contract, and the contract is between 2 parties. This contract, to one party, it is becoming a financial asset, and to the other party, the same contract is becoming a financial liability or equity. This contract is called as a financial instrument. So if you ask me what is a financial instrument is nothing but it is just a contract. E contract lo 2 parties are there. For one party, e contract is a financial asset. For other party, this contract is either a financial liability or it is an equity instrument. Now, this is formally the definition of financial instrument. Now you see, this definition is not of much use for us. No big use. Because what will you do with this definition? Because any definition, for example, intangible asset is there. Intangible asset ka definition is there. That is very important, because if you satisfy that intangible asset definition criteria, then only we will go and do recognition criteria, measurement principles and all that. But here, if you ask me, sir, what is accounting or financial instrument, and there is no answer I can give you. Financial instrument definition, sir, there are 3 ingredients. 1, financial asset, financial liability or equity instrument. Accounting is there, accounting guidances are given for liability, financial asset and equity instrument, not for financial instrument as a whole. So you should put more efforts on understanding what is an asset, what is a financial liability and what is an equity instrument. Now, even before we go into the discussion definitions of financial asset, financial liability and equity, just quickly based on our existing understanding, imagine, sir, this fellow Mr. X, he purchased 10% Reliance Industries Limited bonds at rupees 1 lakh, which are redeemable at 5 years. Now, this fellow bought a bond. Because he bought a bond, from Reliance Industries point of view, if you observe, this company has an obligation to pay this money back to the holder or the investor. So for Reliance Industries, this particular bond is a financial liability. But for the investor, he has a right to collect cash from the company. This right is resulting into a financial asset. The basic preliminary understanding, sir. Definitions we will see slowly. Similarly, if I tell you that he did not buy bonds, he purchased proper equity shares of Reliance company. For Mr. X, equity share is still a financial asset, but for Reliance Industries, equity share of their own company is called as an equity instrument. So for one party, the contract is a financial asset, but to the other party, it can become either a financial liability or equity instrument. Now, although directly the standard does not define something, but I am telling you, that party to whom the contract is becoming a financial asset, this fellow is called as holder. That party to whom the contract is becoming a financial asset, that fellow is called as holder. I am not talking about holder of call option, put option, not that. Generally, sir, he is holding a bond. No, he is holding an equity share. He is holding a right to collect cash flows. That's why we are calling him as holder. And the person to whom the contract is a financial liability or it is an equity instrument, that fellow is referred as issuer entity. So the parties in the contract are two fellows, sir. One is the holder, the other one is issuer. For the holder, the contract always will become a financial asset. But for the issuer, the contract can become either a financial liability or an equity instrument. Once India's 32 will finish off, you look back and see, you will only tell me that, sir, India's 32 lo 90% of the discussion will be only fighting between whether for the issuer this contract is a financial liability or equity instrument. Rest of the points are very small, very direct, very trivial. The main discussion, the important discussion, if at all India's 32 is big, that is only because of lot of discussion is there regarding whether this contract will become a financial liability or equity instrument for the issuer. Asal holder ki doubt hai not there, sir. That fellow it is always a financial asset. Now let's see what are the definition parts for this. Now, sir, these definitions are very, very huge. Entire definition we cannot cover right now. Limited coverage only I will do. Remaining parts as we go into the standard, automatically they'll get opened up. If I start explaining entire definition now, it is as good as I'm explaining the entire standard itself. So certain points later on we will cover. Later on, since today only, in this session only, as we go inside the standard you will see. Definition, keep it limited initially. Look at financial asset definition. Financial asset is any asset that is cash. So directly cash is your financial asset. When I say cash, automatically it covers cash in hand and also cash at bank also is covered. Next, equity instrument of another entity. The cash what you are having, that is anyway financial asset. Equity instrument of another entity, if that is your asset, that asset also is a financial asset. Simple example, I purchased 1000 shares of Reliance Industries. 1000 shares of Reliance Industries is Reliance Industries, some other entity, some other entity ka shares, if they become my asset, then that asset is a financial asset. Because financial asset is any asset. So first of all, it should be your asset. And that asset should represent equity instrument of another entity. Other entity ka equity instrument if you are holding, then it becomes a financial asset for you. Sir, what if I hold my own equity shares? Tell me, sir, can you buy your own company ka equity shares? Normally, no. You can, because if you buy your own company ka equity shares from the market, buyback provisions will be attracted. Section 68 or something is there. Within 7 days, you have to destroy the shares and cancel the share capital. Correct, no sir? You cannot buy your own shares, at least in India. But outside India, there are some countries where you can buy your own shares, hold them, and subsequently you can sell them also or cancel them. This is called as the concept of treasury shares. The India law not applicable, but outside India it is permitted in some countries. Now why I am giving you introduction for that is, in case you buy your own company ka shares from the market and hold it, okay, that does not qualify to become a financial asset. Law may permit it. In India it does not permitting, sir, but some other country may permit, no, or India law provisions can be amended, no sir. So even if it is permitted in India also, that will still not become a financial asset, because if an equity share has to become a financial asset, it should represent equity share of some other company, not our own entity. And the second point come here. The most important one is a CBIT or CBIT A1. A financial asset is an asset that is a contractual right to receive cash or other financial asset from another entity. So you should have a right to receive cash. So now 3 points we have discussed, sir. One is straight away cash is financial asset. Equity instrument of another entity is a financial asset. Another entity. Third one is, he says you should have a contractual right to receive what? Receive to either cash or any other financial asset. So first of all, we are reading financial asset ka definition. In the definition again they said that right to receive a financial asset is also a financial asset. Let's put some examples. So for this example is very straightforward, cash bank. For this, equity shares of some other company is a financial asset, very straightforward. Now you should tell me examples for the third category. Tell me, contractual right to receive cash, which one? Examples. Good, let's start with the basic one, which is trade receivables. Right, sir? Trade receivables. You have fixed deposit with the bank. Bills receivable. In trade receivables, what happened? I sold goods on credit. I have a right to receive money from you. Bills receivable, I have a right to receive money from you. So all this will fall into contractual rates, therefore financial assets. Similarly, loans given. I gave loan. Do I have a right to receive money from you? Yes. Somebody told investment in debentures or bonds. All deposits are covered. Investment in deposits, debentures or bonds. Recurring deposits, fixed deposits, they are all covered. Security deposits are also covered. What is security deposit? In some contract you have deposited money for performing some work. Once you perform the entire work correctly, they will give back your deposit. Or you have taken a property on lease. Normally whenever you take any house on rent, what will the owner say? Sir, please pay 3 months advance. That is nothing but the security deposit. That deposit, you have a right to receive it back when you vacate the property or when the work is done. So that right to receive is there, therefore this becomes a financial asset. Many examples are there. You tell me this, whether this is a financial asset. Investment in convertible bonds. Peacefully think and answer. Investment in convertible bond. So first of all, so bond cash flows means what all cash flows will be there in a bond. Suppose I have a 4 years bond. Next 4 years ki I will be having a right to collect cash in the form of interest. Normally if it is a redeemable bond, last law I should get the maturity value in cash. But this is not a redeemable bond. This is a convertible bond. So instead of maturity value, I will be receiving the equity shares of this company, whoever has issued bonds. So as far as discussion up to here is concerned, this is contractual right to receive cash. This is contractual right to receive equity shares of another entity, which is also a financial asset. So this also will become a financial asset. Are you understand? So third point, what is covered is contractual right to receive cash is covered. Contractual right to receive any other financial asset also is covered. In this convertible bond, I am having a right to receive cash also. I am having a right to receive equity shares also. Since equity share of that Reliance company is also a financial asset, right to receive such financial asset also will become a financial asset. Are we clear here? Right, sir. This is all about financial asset. There are some more points later on we will see. Next, come to financial liability definition. Now, sir, in financial assets, we learned 3 points. In that, third point ka opposite version you think. What is the third point? Contractual right to receive cash is a financial asset. Opposite is what? Contractual obligation. Could receive cash, here to deliver cash, pay cash. So a contractual obligation to deliver cash or other financial asset to another entity. If you have obligation to pay cash to anybody, and that obligation should be a contractual obligation. If you have a contractual obligation to pay cash to anybody or deliver any financial asset to anybody, then this contractual obligation must be treated as a financial liability. Now, financial asset, 3 points we have discussed, but financial liability, only 1 point we are talking now, which is a contractual obligation to deliver. That means you should pay what? Pay to somebody. What? Either cash or any other financial asset to another party. Then this obligation is called as financial liability. Here, which examples will sit? Of course, trade payables is an example, and bills payable, then loan payable, loan whatever we have received from a bank, we have obligation to pay. Debentures issued which are supposed to be redeemed. We have discussed on some other day previously, preference shares issued, they are redeemable only, no? We cannot issue irredeemable preference shares. Assuming that dividend on preference shares is mandatory for a moment, redeemable preference shares also are financial liability. Okay, answer this. Electricity bill outstanding. Electricity bill outstanding. This month ka bill ochindi sir, we did not pay. Balance sheet it's appearing. Financial liability, yeah? No. Financial liability. Don't think whatever is written there, other definition. Think based on that. No mind application. It is a financial liability. It is a financial liability. Are you obligated to pay contractually? Yes. Outstanding expenses. Yes, you have a contractual obligation to pay. Prepaid expenses. Why no? Prepaid expense cannot be liability, sir. Prepaid expense can be a financial asset or not is my question. Prepaid expense, I paid in cash, but is it cash? No. Is it equity share of other company? No. Do you have a contractual right to receive cash? Any other financial asset? No. Prepaid expense, we have a right to receive goods or services, but not cash or financial assets. You might have paid in cash, that is irrelevant. What you are going to receive, that is important. We are having a right to receive some goods or services. So prepaid expenses cannot become financial asset, but outstanding expenses will become a financial liability. I don't understand, sir. Prepaid expense opposite outstanding expense only. No, prepaid expense is not a financial asset, but outstanding expense is a financial liability because you have to pay in cash. Tell me this. Okay. Provision for tax. Provision for tax, is it a financial liability? We definitely have a obligation to pay cash. And what is stopping you from financial liability? There is no contract. Between me and government, any contract is there? No. That is statutory obligation. But not a contractual obligation. Therefore, not a financial liability. The same goes with income tax refund receivable also. Income tax refund receivable represents a right to collect money back from the income tax authority. But that right is coming because of a law, not because of a contract. Are you clear here? Right. Look at this. When we discussed the provision, we have discussed the provision standard. Provisions. Provision is defined as a liability, and liability is defined as a present obligation. Obligation discussion we did, there are two types of obligations, either legal or constructive. I told you legal obligations are created because of two reasons, either because of binding contract or because of law itself. Constructive obligations are created because of our own creation. Now, correctly observe, the linking between Ind AS 37 and 32. Obligations, no sir, legal, constructive. But restructuring provision is there, as a constructive obligation. Your obligation to refund money to dissatisfied customers on your own past practice is there, as a constructive obligation. You made a promise to people that you will rectify the damage caused by you to the river nearby, constructive obligations. Legal obligations, two types they are created, either because of a contract or because of operation of law. Now, the general discussion on obligations which we have discussed while doing Ind AS 37. Ind AS 109 talks not about all obligations, only this, contractual obligations. Legal obligation also is a liability, constructive obligation also is a liability, but they are covered elsewhere, not under this standard. You will ask me, sir, but contractual obligations are already covered under Ind AS 37, no sir, no. I only told you what are the type of obligations. Ind AS 37 for that matter covers both the obligations. But what did I tell you while doing Ind AS 37? If Ind AS 37 has to be applied, first of all it should be a liability, then it should not be covered by any other standard. If nobody covers, then only it will enter here. But provision for tax is there, a pakka legal liability. But Ind AS 12 is there, this standard is not applicable. Provision for gratuity is there, contract between employer and employee. Pakka obligation, pakka liability, estimate is also there, but still not covered under Ind AS 37 because Ind AS 19 covers that. Okay, I was just telling you the meaning of obligations. Now for more clarity, answer this. What about this one? Think peacefully, you'll get more clarity. Warranty, is it covered under this standard or not? Even without thinking you can answer, but I want you to think and answer, because already warranty question you have seen in the Ind AS 37, so it's covered under Ind AS 37, not here. But why? What is missing? Sir, warranty is between entity and the customer. Definitely the contract. So contractual obligation is there. To do what? If a customer comes back with a defective product, I have an obligation to repair it or replace it. Do I have obligation to refund the money there? No. Sir, but you will incur money to repair this. No sir, correct. I will incur money to repair it. I agree that. But financial liability definition is not that. Read the definition. Contractual obligation to deliver cash or financial asset to another party. Will I pay cash to you if you bring me defective product? No. What will I say? Bring that. I will repair and give it. I will incur cash. I repair it and I give you good product to you. If repair is not possible, new product I will give you. But I will never pay you cash with my own hands to you. Since obligation to deliver cash is not there, warranty obligations are not financial liabilities, even though there is a contract underlying that. That is the reason they are scoped out from 109 covered under Ind AS 37. Right. Next one. Guess this. Financial guarantee is given. Financial guarantee means normal guarantees are. Some Mr. X is taking loan from ICICI Bank. ICICI Bank told, looking at your face, I'm not feeling like I give you loan. Bring somebody of very high repute. That Mr. X came to me. So I went to the bank. I told the bank that I know Mr. X, you like my face, no? Give loan to him. Then bank told, if he doesn't pay, will you pay? I say, yes, I will pay. I signed and gave it. What I have given is a guarantee to the bank on behalf of Mr. X. This is called as financial guarantee. Now tell me, sir, is this financial guarantee a financial liability for me? Sir, contingent or not contingent, or leave it all that. Based on contractual obligation point, based on just this point, you answer. If that fellow defaults it, then we have a contractual obligation to deliver and pay cash to the bank, isn't it, sir? Definitely it is a financial liability. Now, when you did AS 29 somewhere in the past, provision key contingent liability, when doing this discussion, contingent liability key classic example that is given in cainter is guarantee given. Whatever guarantee I am talking now, a guarantee you have promised to the bank that you will repay the loss to the bank if the original borrower does not repay the money. So you may pay, may not pay. It depends on some uncertain future event, not wholly within the control of the entity. Therefore, you simply disclose it as a contingent liability. This cainter law we studied. But when we did Ind AS 37 at quite a length, I never gave you guarantee example. You know why? Guarantees are not covered under Ind AS 37. Today, unlike your AS 29, guarantees are not treated as contingent liabilities. Guarantees are treated as proper liabilities, and for that detailed accounting is there. And it is covered under Ind AS 109. Recently also question came, 8 marks to 12 marks. So guarantee is properly accounted as a financial liability. Now you can ask me, sir, but guarantee ka amount, whether we will really pay or not, it is uncertain. No, how will you do accounting for full amount? I will not do for full amount. I will do for some estimated amount. How to do all that later on we will see. But prima facie, just understand that guarantees given are a financial liability, because if things turn unfavorable for us in future, we end up paying this money to the bank contractually, right? So guys, this is a story about basic definition of financial asset, financial liability. Look at the next part, sir, which is equity instrument. Sir, what about the remaining part of definition? If you read that, your opinion on financial instruments will change. Don't read now. Once entire standard is over, if you still have any juice left in you, go fight out with the definition. You will understand. There is nothing you will not understand. You will definitely understand, but not now. Once you finish off the standard, you can come and play with that. Come to equity instrument definition. Normally, sir, don't read, think. Equity instrument means what? General, based on our existing understanding, or from the word, what is coming into your mind? Equity instrument is nothing but our own equity shares are equity instrument. At least if that thought is coming into your mind, that is perfectly right. But the definition, you see how they have given. An equity instrument is any contract that evidences a residual interest in the assets of the entity after deducting all of its liabilities. So very interesting definition. You see what he says is, imagine there is a company, sir. In company, so many assets are there, so many liabilities are there. Suppose this company is liquidated. So what will happen? Assets are sold, liabilities are paid off, settled off. After paying everything, still some money will be left. Our money belongs to some people. Those people will be holding some paper in their hand. That paper, which gives you right on residual net assets, a paper is called as equity instrument. So equity instrument is that contract which gives you a residual interest in the assets after paying all the liabilities. After paying all the liabilities means indirectly he is saying that in the net assets, if a fellow is having a right, he will be holding a paper in his hand. That paper is called as an equity instrument. The classic example of equity instrument is the normal ordinary equity shares. Ordinary equity shares of entity will definitely become equity instrument. Now, while discussing the original definition of financial instrument, I told you, the entire standard is all about demarcating between what is equity and what is financial liability for an issuer company point of view. Now, when will you call something as financial liability? You will call something as financial liability when we have a contractual obligation to deliver cash or any other financial asset. This is equity instrument. So based on understanding of financial liability, I'll write some points for equity instrument. You see whether you are able to link up the conceptual version of this, because the definition version also it is there, but it's difficult to comprehend. Understand this. Equity instrument shall not create any obligation on the entity to deliver cash. Because if contractual obligation to deliver cash is there, I will not call you as a equity instrument. I have to classify you as a financial liability. So equity instrument lo there should be never an obligation to deliver cash, or to protect the returns of instrument holders. Sir, among so many instruments issued by a company, which one is the most risky one? A company issues bonds, a company issues preference shares, a company issues convertible shares, a company issues normal equity shares. Who will get payment in the last? Equity shares. Even at the time of distribution of income also, equity share last day. Liquidation also, equity share last day. That fellow who takes money after paying everybody, that fellow is called as an equity instrument holder. Whatever standard says is, if you have to become an equity instrument holder, the company should not promise you any fixed returns. If somebody is taking fixed return, how can he become an owner? Sir, fixed returns to whom do we pay? Lender of money we pay. Sir, I am doing a business, sir. I only started the business. I am the promoter of this. I invested some money. If you come and tell me that, Mister, you will receive only 15%. Beyond that, if you get 1 rupee also, that is mine. Will I be called as an owner now? If my returns and risks are limited, how can I become a, or how can I call myself as a owner? So if you have to call yourself as an equity instrument, your risk and reward potential should be unlimited. There should not be any caps on how much return you will make. Suppose the company makes a promise that we will ensure that every year you will at least make a return of 8%, and a company took money from you. In your hands they put some paper. Let them call that as equity share, let them call this as convertible debenture, let them call it as anything. But the moment a company promises or fixes your return, gone. You are not a equity instrument holder. Equity instrument ki protection should not be there. So that is that. The company should not have any obligation to pay you cash, nor the company should have any obligation to protect the return of instrument holder. If these 2 points are there, you automatically will fall into a financial liability. Who will ask every year return irrespective of your performance? Tell me. Lenders will ask, debenture holder will ask, loan fellow will ask. I don't care whether you make profit or not. I gave you 10 lakhs, you have to pay me 1 lakh every year. Are you owner? Huh? No. Owner will not ask like that. So equity instrument ka definition you have to understand qualitatively. Now let's give you an example. One example is this one, equity shares of the company. Look at another example. Company issued irredeemable preference shares with discretionary dividend. I raised money today. What I gave you is preference share, but a preference share is irredeemable. Life will never repay this money to you. Sir, how can you issue against the law? Go to hell with stupid law, sir. Who cares what is there in law? The law is country specific. The international standards what you are studying. In some other country it is permitted. So exam they will come. Exam when this question comes, will you write India law not permitted? How can you ask me this question? So don't try to defeat the question. Try to answer. irredeemable. Do I have obligation to pay? No. Discretionary dividend ka meaning is what? Every year dividend I may pay, I may not pay, depending on whether I am having profits or not, whether I don't need money for some other purpose, then I may give you dividend. But I don't have a obligation to pay dividend. Even in this perpetual instruments, irredeemable debentures and all, or irredeemable preference shares, some cases, so sir, company will say we have a right to repay after 10 years. I will say irredeemable, but in that contract I will say that I have a right to redeem it after 10 years anytime. But you cannot ask as a holder. Company will have a right to redeem. There is a difference also. There is a difference between the holder demanding payment versus the company will pay if it wants to pay. There is a lot of difference. It will become a financial liability only if the other party has a right to demand, which creates an obligation on my head. If I tell you that it is optionally redeemable at the option of the entity, then it cannot become a financial liability because I don't have a obligation to pay like that. So company issued irredeemable preference shares with the discretionary dividend. I don't have obligation for the principal. I don't have an obligation for returns also. Purely classic equity instrument. Pure equity instrument. There is no doubt on that. So this is the meaning of equity instrument. Now you see financial asset definition, financial liability, equity definition. Now financial asset lo three parts. It's either cash, the equity instrument of another entity, or a contractual right to receive cash or any other financial asset. Here we discussed only one point, that is contractual obligation to deliver cash. Equity, this is that instrument which gives you right on or right on the residual interest in the net assets. So instrument which gives you right in the residual net assets of the entity. That instrument is called as equity. Now an instrument which gives you right on the net assets of the entity after paying all the liabilities, instead of remembering that, although you remember that, you can remember this. If you have to become an equity instrument, you should not create any contractual obligation on the entity to pay cash or to deliver any kind of return. If you create an obligation, you will become a financial liability. So till here clarity is there. Now look at this. Our next discussion is on derivatives. Now you see, ma'am, in this standard, they have defined what is derivative at length. They have given you the accounting treatment of derivative. But market lo how many types of derivatives are there, how they function and all, that obviously Indians will not discuss all that. No, that is the knowledge which you should have separately based on your AFM knowledge and all. But here little briefly we'll try to touch the aspects of various derivatives and all, so that if somebody has not covered your AFM yet, or you are not very sure with your basics, so it will be kind of help with you. So people who have already have a fair idea with the basic of derivatives, this might be slightly boring for you because you already know that, but still pay attention. There might be 1 or 2 points which are important. Sir, look at the term. The term derivative means it is a contract which derives its value from something else. That something else is called as underlying or underlying asset rather. So there is a contract. A contract ka value depends on the value of something else. So a contract ka value is not based on its own performance. A simple example, people have done with your AFM, or generally you see, there is a bond, sir. Bond is a debenture. If I ask you what is the value of the bond, how will you work out the value of the bond? You will ask me, sir, a bond will give us what cash flows. I'll tell you, for the next 4 years you will receive interest, lastly you will receive maturity value. Immediately what we will do, all these cash flows, you discount it to today. You will get one present value. That only is the value of the bond and you will call. Remember this, people have done at least. Here, bond ka value is based on what? Bond ka cash flows. Isn't it? That means what cash flows bond will give you, based on that I am valuing the bond. But the derivative ka value is not valued like that. The derivative ka measurement or derivative ka worth is based on something else. Since something else is deciding what is the gain or loss in this contract. Therefore, a contract is called as a derivative. And these derivatives usually will have no or less initial investment. Sometimes zero investment, sometimes investment amount will be there, but that will be very, very small compared to the overall value of the contract. And derivatives are always settled in future. These 3 points are the definition of Ind AS 32109 for derivative contract. That's all. And later on they directly proceed on explaining how to do accounting for derivatives, which we will see at length while we do Ind AS 109. But what are the various type of derivatives? How to identify gain or loss? A little bit of knowledge we will discuss so that it will help us while doing sums and all. Now sir, suppose you want to enter into a derivative contract. Where should you go and enter? There are 2 places where you can find derivative contracts. Number 1, stock exchange. There are some derivative contracts which are traded on exchange market. There are some derivatives which are not traded on an exchange contract, but party to party you can construct a derivative contract. For example, between you and me, we can create a derivative contract. So these are called as over the counter contracts. So derivatives can be entered on a stock exchange, or they can be entered across the counter with some other party. Now, the derivatives what you enter on stock exchange, they are basically standardized. The terms of these contract are standardized terms in contract. Who decide these standardized terms? Not you, the exchange. The exchange already fixes the terms and conditions of the derivative product, whereas over the counter contracts is tailor-made contracts. They are customized contracts. Who will decide this? Made by parties. A simple example, ma'am. On a stock exchange, forget about derivative. You purchased a share, normal share you purchase, cash market. Do you know from whom you are buying? You never know. Because exchange market price is there, you put some buy price, price exactly matched with the price what you quoted, transaction gets triggered. On this side, like how you put a buy price, on the opposite side some other fellow has put a sell price, both matched, order got executed. Do I know who is the other fellow? No. Like that, the derivatives that are there on stock exchange, you never know who is the other party. Between me and the other party, in between who is there? Stock exchange is there. But derivative contracts are entered, they are settled, they are executed, they are transferred. All this drama happens, but the parties never know each other. So when parties say do not know each other, how will they decide terms and conditions are? They will not decide. That's the point. When parties do not know each other, how are the terms and conditions of the contract written? They don't decide that. Who decides that? Stock exchange already a standard format is there, standard terms are there, how much quantity you should buy, decided. When the contract should be executed, the maturity period, decided. Price already there in the market. Everything is there, sir. So then what are we doing there, sir? You are just taking a position. Either you will become a buyer or you will become a seller. Whether you want to become a buyer or seller. When you want to enter, when you want to exit, and then a decision making. Price you also cannot decide. You can have a wishful price, but you cannot decide the price. I don't understand, sir. I will buy share from that girl only, and you can't say. You never know who is she. First of all, she or not also you do not know. So, stock exchange law, the other party you do not know, terms and conditions you don't decide, everything is standardized. On the other side, over the counter contracts are directly, I know the other fellow, me and that fellow will sit across the table, decide all the terms and conditions and then enter into a contract. If you over the counter contracts. Now what are the examples we have here? Options contract, futures contract are very popular stock exchange traded derivatives. There are some more examples also like interest rate futures and all, but they all again will be covered under futures only. Now coming to over the counter. Over the counter, a hell lot of examples are there. The basic forward contract what we enter with a bank is a over the counter contract. What's the meaning of forward contract and all? We'll come to that slowly. An option contract can be created over the counter also. Sir, what about future contract created over the counter? Future contract created over the counter only is forward contract. Okay, option contract can be created between you and me also across the table, or you can buy it on a exchange market also. Next, swaps. That means interest rate swaps, currency swaps, they are all over the counter contracts. Forward rate agreements. There are a lot of examples. Over the counter there is no limit, no sir. You can create any kind of derivative you want. Anyway, in this sir, most important for our discussion and solving some questions is futures, options and forward. This much definitely you should know. Means detailedly only. I'll not ask you to go and value an option or value a futures, not like that. Basic functionality of the contract you should have full clarity. Otherwise, some questions also you will not understand. We are not solving any questions, just to peacefully try to understand. First one, sir, we'll discuss what is a forward or future contract. Sir, forward and future both are same, 100% same, okate point different. Only one point. This is a over the counter contract, this is a exchange contract. Apart from this, rest all is totally same. Let's see how a forward works. It means it is a contract entered today to buy or sell on a future date at a predetermined price. This predetermined price, we will call this as forward rate, or in futures contract it is called as futures price. So the contract is entered for buying or selling. Buying or selling will happen in future, but price is already decided today. A decided price we are calling it as either a forward rate or a futures price, depending on whether it is forward or futures. Contract is entered. This contract is called as forward contract. Now let's put some example. Today there is a contract entered between bank and the customer. This one is a customer. The contract is the customer will buy $1,000 at 3 months time from the bank, and to the bank customer will pay rupees 80 per dollar. Who is agreeing to buy? Customer. So who is agreeing to sell? Bank. This is classic example of forward contract. Same contract you can enter on stock exchange also. In that case we will not call it as forward, we will call it as futures. The price is already locked in this. What is the price? 80. This is called as your forward rate. Now tell me, sir, when this contract actually will be executed? After 3 months. Now, at 3 months time, the spot rate in the market is $1 is equal to 88 rupees. Market lo $1, if I have to buy or sell, it will give me 88 rupees. But under this contract, I agreed to buy dollar only at 80 rupees. So gain or loss? Gain. How much gain is there? 8 rupees is there. Who is happy? Customer is very happy. Who is not so happy? Bank. Because Under this contract, they are obligated to sell the dollar only at 80, even though the worth of the dollar in the market is 88. So tell me, sir, here, what is the gain to customer? 8 rupees 8, 88 minus 80, or there is rupees 8 per dollar. Similarly, there is a loss to bank, same amount, which is rupees 8 per dollar. This is one thing. Now on this date, what happens is, the two parties, that is the customer and the bank, ideally this fellow should buy the dollar by paying an amount of 80 rupees. He is extremely happy. Why is he happy? The dollar worth is 88, but he is able to buy that only at 80. Suppose, can this customer do like this? He take from the bank dollar at 80. Immediately after 1 minute, hi bank, take this dollar, give me rupees 88. Can he do that? Yes. Obviously, happily he can do that. That means, can he make a gain of 8 rupees? Yes. 8 rupees cash rate will come off to you indirectly. This is called as gross settlement. Gross settlement means whatever you agreed to do, that you are doing. That is, you agreed to buy and you are actually buying. There is something called as a net settlement also. What is net settlement is, I never have any intention to buy dollar, nor the bank has any intention to sell dollar. We both entered into a betting contract. I told that dollar will cross 80. He says that much scene is not there. I told bet. Ultimately, we entered into a betting contract. Price crossed 80. I won. He lost. Pay me 8 rupees. So, in case what will happen is, this dollar is the drama, sir. Bank, nicely he will receive rupees 8. Whether you do gross settlement or whether you do net settlement, anyway, customer is gaining, banker is losing. Our points are not going to change. Amount of gain, amount of loss also not going to change. It's just a matter of settlement. Sir, is net settlement allowed, sir? Gross settlement allowed, sir? That depends on party, sir. A contract is not a standardized contract. No, this is a contract which is entered over the counter. So our parties will write only net settlement A. Okay. Gross settlement option is there. That is your wish. You write whatever you want. This is a derivative contract. Are we clear here? Right. Suppose the dollar rate is not 88, it is 78. When market dollar rate is 78, I agreed to buy dollar at 80 under the contract. So definitely customer will be at a loss. Loss to customer. How much loss? I am buying at 80, but market rate is 78, 2 rupees. So bank will definitely make a gain in this. How much gain? The same 2 rupees. Settlement and all drama same to same. Only thing is this side, this time will be little sad. That's all. Now what I want to tell you from this is, in a forward contract, or for that matter in a futures contract, when will you gain, when will you lose? If ultimate market price is greater than your forward rate, or market price less than your forward rate, then that fellow who has taken a buy position, and there is a fellow who would have taken a sell position. The person who took a buy position, we also refer this as a long position. The person who agreed to sell, we also call it as a short position. Some other subject, somebody else will eat your head on that. So, but matter is that. Tell me, sir, how you have to eventually remember this table, sir, but not by hearting it, feeling it. Tell me, what is the meaning of buy position? Agreed to buy, agreed to sell? Agreed to buy. Agreed to buy at what rate? Forward rate. Now look at first case. Correctly, all of you focus, sir. I agreed to buy at this rate, but market actual price is higher than that. So are you happy or sad? I agreed to buy at 100, market price is 150. So I'm happy or sad? Happy. So this is a situation which will give you a gain. Are you understanding, ma'am? Now answer this case. Sell position means what? I agreed to sell something in future. At what rate? Forward rate. But actual market price is less than that. It's like I agreed to sell at 100, market price is 70 only. So agreeing to sell at 100 is better than selling at 70, no? So definitely I am in an advantageous position. This also is a gain. Don't tell me remaining two loss, that I know. We are not playing tic-tac-toe. So thinking is important. Sell position, E case. I agreed to sell at forward rate, but market rate is higher than that. So I am selling at a lower rate effectively. If I am selling at a lower rate, good or bad? Bad. This is a loss. The last case, I agreed to buy at forward rate, but market price is lower than that. That means I am effectively buying at a higher rate. Buying at higher rate is bad. Therefore, this is a loss. Let it be forward, let it be futures. Gain or loss ka rules are not going to change. Are we clear here? Okay. Idhe story in another way, much more crudely, inka simplified ga, if I should tell you, a person who has taken long position will gain when price increases. Person who has taken short position will gain when the price falls. This sentence, if I should put it, rising market low, long positions will give you gain. Falling markets low, short positions will give you gain. This is a basic formula, sir. This you should have by default inside. Otherwise, certain questions interpretation also will be very, very difficult. Now, suppose I tell you, price is going to fall down. And I'm feeling whether it will really fall down or not, God only knows. But as on today, I believe that price will fall down after 3 months. Which position I should take? Short position. If I believe that price is going to rise, then I should take a long position. Long position means what? Agreeing to buy. Short position means agreeing to sell. You should know this reverse also. There are some questions, interpretation will not happen. He won't even tell you that price is going to fall. A hint also you have to catch from the question. If price is going to fall, what position this fellow will take in forward contract? Short position. A point you should know already. Then only a question ka interpretation is possible. Some questions are deep, sir. So for that, a background is required. Are we clear here? In forward contract, last point now. Sir, this is 1st Jan. This is 31st March. On 1st Jan, one forward contract is entered between bank and customer. Customer agreed to buy $1,000 at $1 is equal to, let's say, 70. If customer agreed to buy, then who is agreeing to sell? Bank is agreeing to sell. Agreed to sell $1,000 at the rate of $1 is equal to rupees 70 at 31st March. So this contract is going to be settled on March ending, but the contract is entered on 1st of January. Price is already freezed. Customer is a buyer, banker is a seller of dollar. Fine. Ideally, this contract will be executed on 31st March. But before 31st March, let us say on 1st of February, the customer wants to cancel the contract. You already are a party in a forward contract or a futures contract, but before the maturity date, you want to get out of this. Now, how to get out of this? First of all, can I get out? Yes, there is a provision by which you can get out of your existing contracts. So, how to get out? It is not like you simply go and call the bank and tell him that, sir, we both thought of executing a forward contract on 31st March. Still 1 month, 2 months time is, let's make it 28th February. No? The space is less. I tell the bank that there is still 1 more month of maturity. but I cannot execute the contract. Bye bye, sorry for the inconvenience, not sufficient. If you have to cancel the forward contract, you have to enter into an opposite contract to do this. You should enter into an opposite contract in such a way that a second contract should go and kill the first contract. So if when both the contracts get executed, the first one and the second one, effectively you need not buy dollar, you need not sell dollar. That sort of situation you have to create. You tell me the provisions of this contract. Customer, what should he agree to? Originally we agreed to buy. Now the customer should agree to sell. Same amount of dollars. At what rate I will tell you later on. Bank should agree to buy $1,000 at the rate of. Now, which rate is applicable for you? First thing, tell me, the opposite contract, whatever you are entering, is this also a forward contract? Yes, because even though this contract is entered on 20th February, this also is supposed to be executed on 31st March. This also will be executed on 31st March. They both will kill each other. That's an idea. So the opposite contract also is a forward contract. So since opposite contract is also a forward contract, which rate is applicable? The remaining period. How much is remaining period? 1 month. A 1 month forward rate will be applicable for this contract. So let us say your 1 month forward rate is $1 is equal to 65. The moment the customer and bank enters into opposite contract, it is as good as the original contract is cancelled. Because if you see like this, this is the customer, this is the bank. My original contract is, I told him that I will buy dollar, I will pay him 70. In the second contract, I am saying that no sir, I cannot buy dollar from you, so I am cancelling the contract. So I will enter into a sell contract, sell dollar now, and you pay me. Somewhere some mistake happened. Yeah, I will sell dollar and the bank will pay you an amount of rupees 65. There are two contracts now. This is the original contract, this is the cancellation contract. But if you observe this part, the middle one, in one contract customer has to receive dollar, in another contract customer has to give dollar. Neither will he receive nor will he pay dollar. So both are cancelled. But these are not same. Therefore, there will be a cash exchange for the net amount of gain or loss. Tell me, sir, customer is gaining or losing? Losing. How do you know that? Simple. He is buying at 70, selling at 65. Definitely customer loses by 5 rupees and banker also gains by 5 rupees. So effectively what is happening in this above transaction is customer should pay to the bank an amount of 5 rupees. The losing party will pay money to the gaining party and the contract is deemed to be closed. Are you understand that this is how you cancel a forward contract or a futures contract before the maturity date? You have to enter into an opposite contract at what rate? At the forward rate for the remaining period you have to enter. In this case, is 65 rupees whatever I have given you, this is a 1 month forward rate. Suppose the contract is cancelled not on 20th February but on 1st February. Then I have to take a 2 month forward rate for cancelling this. Are you all clear here, sir? It is very basic, I understand, for people who have already done your AFM, but this is very, very important for us. Because, sir, if you don't have clarity in this, later on there will be 1 or 2 very complicated concepts. Our time your focus should be on that complication, not on understanding derivative. So that's the reason we are investing a bit of time, don't mind. Sir, with this forward contract ka drama is over. Istadu, Ivali. So for example, in this case he says that if instead of here 65, if it is 75, then customer point of view, customer agreed to buy at 70, now customer is agreeing to sell at 75, the customer is gaining 5, banker is losing by 5, then who has to pay money to who? Bank should pay money to the customer. Definitely he has to pay. He will pay. He will pay. Definitely he will pay. Actually speaking, bank will not suffer a loss. E contract it looks like bank is suffering a loss, but in reality bank will not suffer a loss. That is some of the subject. Okay, next. In this next aspect is options, sir. Sir, anyway, before I jump into options, 1 minute, just recap forward and future. Tell me, sir, forward and future low. I'll just tell you quickly, you see whether you're able to understand or not. Any mistake or any confusion is there, please let me know. Sir, it's a contract entered today to buy or sell goods or any asset on a future date. Price is decided today only. That price is called as forward rate or futures price. First point. Second point. In these two parties, one fellow will agree to buy, another fellow will agree to sell. The fellow who agreed to buy is called as a guy who has taken a long position. That fellow who agreed to sell is called as a short position. That fellow who agreed to buy, he will gain when the price is rising. The fellow who agreed to sell will gain when the price is falling. So two parties with opposite expectation enter into the contract. One fellow believes that price will rise, another fellow will believe that price will fall. Ultimately only one thing will happen, also either price will rise or price will fall. Depending on that, one party will gain, another party will lose. And on the maturity date, a contract can be settled either by way of gross settlement or by way of net settlement. Gross settlement means whatever we agreed to buy, we'll actually buy by paying the full price. Net settlement means you'll not buy or sell, you'll simply exchange the cash for the net amount of gain or loss. Sir, who will pay cash to whom? Losing party should pay money to the gaining party. Clear, sir? Last point. When you enter into a forward or futures contract and you want to get out of that before the maturity date, all you have to do is enter into a opposite contract at a forward rate for the remaining period. Compare that with the original contract rate, you will identify the gain or loss. Either you receive the gain or you pay the loss. Game over. Clear, sir? Chalo, let's move into options. Sir, in options contract, see the name option itself means it is a choice. In the option contract also there are two parties here. One party is called as holder of option. The other party is called as writer of option. The holder of the option will have a right. Writer of an option will have an obligation. Now what right he has, what obligation he will have, we will see later on. But time being, one fellow is having pure right on this contract, another fellow has to simply comply with the opposite person ka right. Now don't you think this type of contract is a kind of one-sided contract? So for example, you and me enter into a contract, sir. You tell me that I have full rights. You don't have any right, you have a obligation. Don't you think the contract is very favorable to one party? That fellow who is having right is in a favorable advantageous position. The fellow who does not have a right but only have a obligation, he is in a disadvantageous position. Then why will he enter in the first place? He should not enter, no. But why he enters is, this fellow who is having a right, he won't get that right by, it's not a birthright and all. A right is something which he purchases by paying some consideration to the other party. So you pay money to the other fellow therefore he accepts the obligation, gives you a right. So this first day amount what we pay, this is called as option premium. In a forward or future contract, starting day low you need not pay any amount to the other party because both the parties are having equal rights and equal obligations. But the one-sided contract, one party has a right, another party has an obligation. That other fellow is not as stupid to accept obligation, no sir. You have to give him money to make him accept obligation because he is obligated and therefore you are having a right. So a right is something which you have purchased it by paying money. Therefore, a party holder, whoever is there, no sir, he is also called as buyer of option. A writer of option is also called as seller of option. People who have finished off with AFM also sometimes make mistake in this. Option holder is always called as buyer of option. Writer of option is also called as seller of option. Are you understanding, sir? Now I did not even tell you how many type of options are there. What right I did not tell you. What obligation we did not discuss. But I am proving that that person who is a holder, that fellow who is having a right, he did not get that right freely. He paid money and he purchased the right. Therefore, that holder of an option is also called as a buyer of option. If I should confuse you more, buyer of option is also called as having a long position. The word long is always associated with buy positions. Short on a word is associated with sell positions. Sir, what right he has, sir? What obligation he has? We will see next. For that, you should understand what are the type of options. In the partition options we have seen. Now type of options. Many classifications are there, but the most important one is this. There are two type of options. One is a call option, the other one is a put option. Now in a call option, holder, writer, the rights and obligations you have to understand. That's all. With that, drama gets over. A call option holder will have right to buy the underlying asset. Means whatever they have agreed, let it be copper, let it be gold, let it be equity share of Infosys, let it be anything, it can be currency, it can be anything, whatever you people agree, that you have a right to buy at predetermined exercise or strike price. Price is already decided. Price ki if you want you can buy. Sir, forward contract lo long position also same thing. No sir, forward contract lo long position was not right to buy. Adi agreement to buy. Whether it is favorable to you or unfavorable to you, you still have to buy it. Here it is not like that. I have a choice to buy. If I want, I'll buy, otherwise I'll not buy. That's the difference basically. Now based on this, you should identify what is this fellow's position. If holder has a right to buy, writer will have a obligation to sell. Obviously at the predetermined exercise price and all, but if holder exercises the option, should the holder say that I am buying, then as a writer you should sell. Sir, price is not favorable to me, I will not exercise. You don't have a right there. Writer does not have a right. Name lo right is sounding, but he does not have a right. Sir, when you did underwriting chapter in your basic level, underwriter takes risk, correct? Similarly, when you did insurance company accounting, various type of insurance, so we are underwriting fire insurance risk, marine insurance risk, underwriting and a word is there. So writer and a word is basically indicating accepting risky positions. Here also this writer accepts risky position by taking money. Basically it's that. So call option holder will have a right to buy. If you remember that word, rest all drama you can create. Because he has a right to buy, that fellow has an obligation to sell, like that. Put option holder. Put option holder also will have a right only, but this time it is right to sell the underlying asset in future at a predetermined exercise price. So the writer of put option will have an obligation to buy the underlying asset if holder exercises the put. Those who have already have an idea about options, you should be basically okay, but people are listening it for the first time. Trick is very simple, ma'am. When I say call option, immediately in your mind it should flash the word holder has a right to buy. If I say put option, holder has a right to sell. Whatever they have agreed that they have a right to buy or they have a right to sell at a predetermined price. Now, let's take an example. Imagine Infosys share is there. Based on Infosys share, there is a call option. E call option X is equal to, let us say, 2500. X stands for exercise price. Maturity is 3 months. This fellow is the holder. This fellow is the writer. Of course, holder pays some money to the writer, otherwise he will not become a holder in the first place. Now tell me, sir, whether this call option low shares will be purchased by the holder or not will be decided only on which date? 3 months time. This is not an agreement. This is a right to buy shares. Call option is definitely a right to buy shares. Whether he will really exercise that option or not, only at 3 months time we can know. So at 3 months time, I'm taking the next page, so it will be easy for you to analyze. I'll also write here. At 3 months time, case 1, market price of Infosys share is 3000. Case 2, market price of Infosys share is 2000. One by one we will do case 1, case 2 separately. Tell me, sir, case 1, market rate is 3000. As a holder, I have a right to buy the share at 2500. Will I exercise or lapse? I will exercise. So the holder exercises the option. Why is he exercising the option? Because the market price is greater than the strike price. Tell me, because option is exercised, holder is making how much gain today? 500 rupees. How 500 rupees? Market low share is 3000, but I am buying the share only at 2500. Therefore, definitely there is a gain of 500. If 500 is called as premium, we'll talk later on, is called as payoff, or if you don't like the word payoff, it is called as the benefit from option to holder. 3000 ka share I am buying only at 2500. So therefore there's clearly a gain of 500. Sorry, 500 rupees benefit, how will I receive? That is exactly what we call it as settlement. Now how settlement will happen? Alternative 1. Gross settlement. Gross settlement, what happens is, sir, whatever we agreed to do, that exactly in letter and spirit you should do. There is a holder, there is a writer. Holder agreed to buy share, so buy. 2500, pay 2500. So you will get one Infosys share and you will pay only 2500. This fellow is sad, this fellow is happy. Why is he happy? 3000 worth ka share I am buying only at 2500. That fellow is selling 3000 worth ka share to me only at 2500. Sir, a writer in generally most of the cases, he will not have Infosys share. Because he has to deliver it to you, today he has to buy the share in the market at 3000 and he has to deliver it to you at 2500. Therefore, a pakka 500 loss he will suffer. And you on the other hand, you paid 2500, took a share, spot life you sell it off also, 500 rupees gain will come into your pocket. This is gross settlement. Alternative 2 is called as net cash settlement. In a net cash settlement, there is no selling, buying will happen now. Only the gain or loss ka settlement will be there. This fellow writer is sad still. What is the fun of delivering share and all? Ultimately my loss is 500, your gain is 500 as on today, so I pay you 500, take it, close the show. This is called as net cash settlement. Sir, between these two, which one will happen? People have done with your AFM can answer. Which one will happen? in stock market? Gross settlement. Things changed of amendment. Change of last year. Reality babu. Reality lo, if anybody holds call option or put option till the last maturity date and you exercise the option, you have to close it by way of literal full delivery of the shares. You cannot do net settlement. 3:30 market closing time, 3:29 you exit. Net cash settlement. 3:30 like stupid, if you are holding there, option gets exercised naturally and you have to do gross settlement. Reality. I am talking about exchange market. Sir, when anyway this is done, why did you write this, sir? What did I tell you? Options are there in exchange market also, over the counter also. Suppose you and me wrote this option. Okay, I told that Infosys share will cross 2500. You said that much in is not there. Then I told that if Infosys price crosses 2500, you pay me money. If Infosys price falls below 2500, I will not pay you any money. This is a deal. Price became 3000. I won the bet. Pay me 500. Kadam, game over. This is over the counter contract. Call option, but over the counter. Between me and you. I know you, you know me, no. You both entered into a contract. Contract is a simple piece of paper. Your notebook, middle page you remove. I will sign, you will sign. Some share you pick up. Let us enter into a betting contract. I will say that if price increases, you pay me money. Price falls, I will not pay you money. Call option is a one-sided betting. Sir, why will I enter, sir? Because I will pay you 10 rupees today. One-sided betting. Two-sided betting is forward contract, futures contract. One-sided betting is call option. Call option is betting to price go up. Put option is betting to price go down. It's as simple as that. Why I wrote the other alternative is OTC contract, so net cash settlement ka option will be there. That's the reason. We'll have questions on all that. Otherwise, we'll not be wasting time now. Anyway, come to the second part. When I have a right to buy 2500, market price is only 2000. So I'll rather buy the share in the open market instead of buying the share under call option. Therefore, here the holder will not exercise. This fellow will lapse the call option. The reason. Benefit is 0. So here holder is very sad, but writer is extremely happy. So you are talking about all this, but why are you not talking about the first day premium paid? Sir, first day premium paid is not relevant for decision making. In your basic capital question somewhere you might have studied that sunk costs are irrelevant. First day I paid, sir, no matter whether I exercise the option, whether I lapse the option, our money is not going to come back. So a premium paid on day one is irrelevant for your exercising or lapsing decision. What is relevant is today will you get a gain or not based on today's price and exercise price. So if it is likely to gain, you will exercise. Likely to lose, lapse it. That's it. Sir, I lost. No, sir. Should I not pay money to the writer? No, you will not pay. The one-sided betting means that only. For that only, first day you paid him what? Premium. This is call option. Put option, it will be reverse, sir. Instead of right to buy, it will be a right to sell. Now, if I should summarize this, it will look like this. Call option, put option, or else it will wait. Market price greater than strike price, market price less than strike price, call option, put option. Sir, people have not listened this concept of options before in your life anytime. Those people alone answer. Others, please keep quiet. Tell me, sir. Call option for holder, what will it give? Right to buy at what price? Exercise price. Now, carefully understand. At this price, I have a right to buy. You will tell me whether I will actually buy under call option or I will not buy. I have a right to buy at strike price, but market price is more. So I have a right to buy at lower price. Right to buy at lower price is good only, no? Therefore, you will definitely exercise the option. Similarly, come here. I have a right to buy at X, but market price is cheaper. So effectively put, I have a right to buy at a higher price. Buying at higher price is good thing, bad thing? Bad thing. So you should not exercise, you should lapse it off. Come here. Now let's come to put option. Put option is not right to buy. Put option is right to sell. As a holder, you have a right to sell at X, but market price is more than that. That means you have a right to sell at a lower rate. Selling at lower rate, good or bad? Bad. So you should not exercise, you should lapse it. In this case, I have a right to sell at X. Market price is lower than X. That means I have a right to sell at a higher price. Right to sell at a higher price is good or bad? Good. Therefore, here you are going to exercise your put option. Are we clear here, sir? When price is rising, then call options are likely to be exercised. Price falling, put options are likely to be exercised. Like that. Sir, any doubt in this? Okay. Two words, two small terms, and then we can go to India's 32 bank. Suppose, sir, there is a call option on TCS share. Exercise price is 3000. Maturity is 3 months from now. This is today data, sir. I am telling you today's market price only. Case 1, 3200. Case 2, 2800. Case 3, 3000. Now each case you should analyze and tell me whether the call option given to you on the left side, is it attractive or not attractive. You obviously cannot tell me whether you will exercise or not, because exercise date is not today. Exercise date is when? After 3 months, not today. After 3 months exercise or lapse. But as on today, is this option looking attractive or not? That's all I am asking. Sir, what is the meaning of attractive? Sir, in call option you have a right to buy or right to sell? Right to buy. Right to buy what? TCS share. At what rate? 3000. Case 1 market price is how much? Today only. Today only share price is 3200, but in contract you can buy the share only at 3000. So in contract is looking favorable or unfavorable to you? Favorable. This type of contracts are called as in the money options, or simply ITM. In the money options meaning is likely to be exercised. It basically means likely to be exercised. I can tell you much more easily also, but that would be wrong. What is that is, compare the price. If you feel that you can exercise today, call it as in the money. But if I teach you that way, it will be wrong. You will wrongly remember that we can exercise it today. You cannot exercise it today. Exercise date is after 3 months. Just for understanding whether it is favorable or not, I am comparing with today's market price. That's all. Second case, sir. Do you think it is favorable? Because a contract is giving us a right to buy at 3000. Market price is 2800. So a contract is likely to be lapsed and not to be exercised. These cases are called as out of the money options, or simply OTM. It means it is likely to be lapsed. Next. Market price, exercise price, both are same. There in this case we refer this as at the money options. This is called as status of options. The concept is called as status of option. AFM it's called as status of options or moneyness of option. Now I'll make a term, sir. You tell me how to understand that. There is a call option that is deeply in the money. What does it mean? What does it signify? When I use the word deeply in the money, what does it signify? Highly likely to be exercised. In the money means likely to be exercised. Deeply in the money means very high chance of option getting exercised. Are you understand the word deeply in the money? Similarly, what is the meaning of deeply out of the money? Out of the money means likely to be lapsed. Deeply out of the money, highly likely that it will be lapsed. As excise ka chance almost zero. I understand, sir. E terminology is there in Indians. He won't teach you what is call option. He will directly say call option deeply in the money. So first of all, what is call option you should know. In the money, at the money, out of the money, you know. Then deeply in the money ka interpretation will come. So that's the reason of developing all this. So till here all good. All senses are working, no? Now let's come back to India 32. Sir, we have covered till now financial asset, financial liability, equity instrument and derivative.